This is the Daily Market Comment by Mario Sachikiriakos. I'm Christina Marujos, and thank you for joining us at XM.com. A powerful recovery in bond yields across the world has inflicted some serious damage on the Japanese yen lately. The Bank of Japan's yield curve control strategy essentially keeps a ceiling on Japanese yields, rendering them unable to join the global rally and making the yen less attractive as interest rate differentials widen against it. Even the nervousness in equity markets couldn't stop the bleeding in the yen, which is generally seen as a safe haven. Looking ahead, the outlook remains negative in an environment of monetary policy divergence between Japan and most major economies. Stock markets started the week on the wrong foot. From paralyzed supply chains to an energy crisis that threatens to cripple Europe and Asia, to growing credit risks in the Chinese property sector, there are several threats on the radar, forcing traders to play defense. The fear is that global growth slows down as companies can cover demand, but inflation remains hot thanks to cost pressures, a toxic combination that central banks are powerless against. And with the fallout from Evergrande spreading across the Chinese property market, with more developers missing debt payments lately, there is a dimension of credit risk as well. That said, this isn't a catastrophe either. Growth is unlikely to slow enough to turn this into another recession, and investors remain fairly confident that any credit events in China will remain isolated. Hence, there is light at the end of the stagflation tunnel, although it's too early to call for the bottom ahead of an earnings season that will likely echo worries around growth and inflation. In the broader FX arena, sterling remains caught in limbo, incapable of capitalizing on mounting bets that the Bank of England will raise rates this year already. British inflation expectations have skyrocketed lately, signaling that this inflation episode will be persistent as the UK is suffering more acute supply disruptions than most economies. As for the pound, the currency's fortunes now hang mostly on how risk sentiment fares. Meanwhile, euro-dollar remains heavy. The picture still seems negative amid Fed ECB divergence, safe haven demand for the dollar, and the American economy escaping a global slowdown with only minor injuries thanks to its self-sufficiency on energy. Thank you for watching today's Daily Market Comment here at XM.com.